Goldman Sachs just told its clients to short cable. Bank of America says the long-term rally remains absolutely intact. One of them is about to get liquidated this week, and I'm going to show you exactly where and when. Right now, GBPUSD is hovering at 1.3455, up near multi-week highs, and the market is completely divided. This week has one danger zone and one 3 to 5 day opportunity. I'll show you both right now. On your screen, the level, 1.3344. That's the invalidation point that resets the entire monthly structure. Stay to the end. I'm giving you 2 Monday scalps and 1 swing trade that can run the next 3 to 5 days, with exact entries and stops. No theories, no maybes. Just the plan that's going on my blotter. This is your instant weekly verdict. For the next 3 to 5 trading days, the structural bias is cautiously bullish. We are trending on the weekly, buying on the daily, but the 4-hour and 1-hour charts are screaming neutral. That tension, between the higher timeframe trend and the lower timeframe exhaustion, is exactly where this week's money is made. The single invalidation level that flips the entire weekly bias is 1.3344. Write this number down. If cable closes any day below 1.3344, the monthly trend that's been building since June is over, and we are looking at a deep correction back toward 1.3262, maybe lower. But if that level holds, the path of least resistance remains higher. Now here's the micro insight the herd is ignoring coming into this week. The positioning data shows retail and a chunk of leveraged funds are still long sterling, riding those multi-week highs. That means there is a fat pool of stop losses clustered just below 1.3340. The market's job this week is to find that pool. Whether it grabs it early and then rips higher, or whether it smashes through and triggers a liquidation cascade, that's the week story. Don't get caught on the wrong side of that liquidity run. I'll show you how to scalp it and how to swing it. Now let's get into the charts. Pull up your weekly candles. Price is trading well above the 20-week moving average at 1.3387, above the 50-week at 1.3350, and miles above the 100-week at 1.3195. The 200-week is way down at 1.3055, almost irrelevant for the short term. This is a textbook uptrend on the highest time frame. The weekly MACD is positive but flattening. Think of it as the macro pulse. It hasn't rolled over yet, so the structural bid is still breathing, but it's losing oxygen. If that MACD bar ticks lower this week, it will trigger a hidden bearish divergence that most traders won't notice until Wednesday's house price data lands. On the daily chart, the trend is a strong buy. The moving averages are stacked. The MA20 at 1.3387 is sloping up. The MA50 at 1.3350 has just crossed above the MA100 at 1.3195, a golden cross that's still maturing. The ADX is reading 25.97. That's above the 25 threshold, so there is a trend, but it's not a runaway freight train. It's more of a grinding rally. RSI sits at 52, dead neutral, no overbought warning. That tells us there's room to run before exhaustion kicks in. But now drop to the 4-hour. This is where the week's trap lives. The 4-hour trend is neutral, and the MACD is printing negative at minus 0.002. That's a slight bearish divergence against the daily uptrend. Goldman Sachs' sell recommendation is essentially playing this 4-hour exhaustion. They're betting the momentum has stalled and a reversal is imminent. Bank of America is looking at that weekly chart and saying, don't overthink it, the trend is your friend. So who's right? The answer lies in the resistance cluster right above us. We have a 1 at 1.3444, a 2 at 1.3476, and a 3 at 1.3526. That's a thick wall of supply. A clean break above 1.3476 opens the melt-up door to 1.3526. A rejection, especially if accompanied by a daily close back below 1.3444, hands Goldman the trade. The weekly pivot point at 1.3394 is the mid-range anchor. Watch that level on any pullback. If it holds a support, the bulls are still in control. The danger zone for the week is actually the liquidity void between 1.3344 and 1.3312. That's S1 and S2. A sweep of that zone would clean out the weak longs and fill in the imbalance before a potential relaunch. But if S2 breaks, we are heading to S3 at 1.3262. Cross a set. Keep an eye on the DXY and the 2-year US-UK yield spread. The dollar has been getting a slight bid from strong housing data, but elevated oil prices from Middle East. Tensions are capping the greenbacks rally. That's giving cable a floor. However, if those tensions ease this week and oil drops, the dollar could surge, and cable supports will be tested. Here's what most traders will miss until Wednesday. Tuesday's CBI Industrial Trends Orders is a leading whisper for Friday's PMI. If UK factory orders come in strong, it suggests the services PMI might also hold up. That's a preemptive bid for sterling that could pop the pair before the big Friday numbers even hit. The market will not wait until Friday to react. It will front run. Now let's connect the fundamental web for the next 5 days. The weekend news gave us two completely opposing institutional views. Bank of America says sterling's long-term rally is intact despite a near-term pause. Goldman Sachs explicitly recommends shorting cable or fading any rally. That's not just a disagreement, that's a volatility fuse. What are they reacting to? The UK data pulse. Early July showed UK Q2 GDP outperforming bearish expectations, but the service sector had some headwinds. Prime Minister Andy Burnham's new cabinet appointments calmed fiscal nerves, so the pound found a steady floor. On the US side, June housing starts surged 19% month-over-month, giving the dollar modest support. But the Middle East premium is keeping the dollar from running away. So we have a stalemate. This week's calendar is designed to break that stalemate. Tuesday brings UK public sector net borrowing and CBI industrial orders. The borrowing number matters because if it tightens, it reinforces the fiscal stability narrative. But the CBI number is the sneaky market mover. Manufacturing health foreshadows the PMI. Wednesday we get the UK ONS House Price Index. Housing stability feeds into consumer confidence and ultimately into rate expectations. Thursday, US initial jobless claims and existing home sales. If claims stay low and home sales beat, the dollar will catch a bid into Friday. But Friday is the week's fuse. The July flash PMIs from both the UK and the US. The UK S&P Global Composite and Services PMI are expected to show lingering impacts of service sector contraction. If that number prints below 50, sterling will get hammered. The US manufacturing and services PMIs are the same day. A strong US services print, especially above 55, would send cable crashing through 1.3394 and straight toward the 1.3344 trapdoor. If both US PMIs disappoint, the dollar gets sold, and cable melts up through 1.3476. So my 1 to 2 week directional lean is this. Mild bullishness survives until the PMIs, but the risk of a sharp Friday reversal is extreme. The exact event that invalidates the bullish view is a UK composite PMI below 48 on Friday, coupled with a US services PMI above 56. That combination would break 1.3344 intraday and likely close us below it. Alternatively, if the UK PMI holds above 50, we test 1.3526. So here's your second interaction trigger. Do you think cable closes above 1.35 this Friday? Comment yes or no right now. I'm tracking consensus for the week, and next Sunday I'll reveal what the herd got wrong. Now it's time for the setups. Most people skip the planning phase. They just jump into the open and react. That's exactly where this week's money is made, in the preparation. Keep watching, because I'm giving you 2 Monday scalps and the 3 to 5 day swing that aligns with the PMI narrative. Strategy 1, the Monday opening scalp. This is a high probability trade designed for the first 1 to 3 hours of the London session. Here's the setup. Over the weekend, the price has been idling around 1.3455. The Asian range typically respects Friday's late levels. We look for a pullback into the 1.3400 handle, which is a psychological level just above the weekly pivot of 1.3394. The trigger condition is this: if price retests 1.3400 and we see a 5-minute candle close firmly above 1.3405, that's the bullish reclaim. Entry on the next candle, long, at 1.3410. Stop loss goes at 1.3385, just below the weekly pivot and Friday's potential low. Take profit 1 is set at 1.3444, which is the first resistance and a natural magnet. That gives you a risk of 25 pips for a reward of 34 pips, a solid 1 to 1.35 risk reward, but with a high hit rate on Monday opens when the trend is daily strong buy. What instantly voids this scalp? If the 5-minute candle closes below 1.3390 before we get the reclaim, the pivot is lost, and the session bias flips bearish. Cancel the trade. The Monday opening SCALP entry, 1.3410, 5M bullish reclaim of 1.3400, stop loss, 1.3385 take profit 1, 1.3444 risk reward, 1:1.35 R invalidation, void if 5M candle closes below 1.3390 strategy 2, the Monday liquidity grab. This is a counter-noise scalp for those who understand how stop hunts work on a Monday. The market knows there are buy stops piled above last week's high. On the 4-hour chart, Friday's high likely tested 1.3470-ish, just below a 2 at 1.3476. There will be a fresh cluster of stop losses from early shorts above that level. The liquidity grab setup is this: we wait for a sudden spike above 1.3476, a wick that pops stops and then reverses sharply. The trigger is a 5-minute candle that closes back below 1.3465 after that spike. That's the confirmation of the trap. Entry short at 1.3460. Stop loss goes above the spike high, at 1.3490, giving it room but still tight. The target is the nearest liquidity pool, which is the 1.3444 support. That's a quick 16 pip scalp with a 30 pip stop, so we're looking for a fast, high probability reversal. It requires aggressive execution and you must be at your screen. The warning: if the 5-minute candle after the spike does not close back below 1.3465, the breakout is real, and the melt-up is on. Do not chase the short trade card overlay the Monday liquidity grab entry, 1.3460, 5M close below 1.3465 after spike above 1.3476, stop loss, 1.3490 take profit 1, 1.3444 risk reward, 1:0.53 R, aggressive scalp, invalidation, void if 5M. Candle recaptures 1.3476. Are you scalping Monday or swinging the week? Comment scalp or swing right now. Let's see who's built for this market. Scalpers need fast fingers. Swing traders need patience through the PMI noise. Strategy 3, the 3 to 5 day swing. This is the trade designed to capture the core move of the entire week, aligned with the structural bullish bias but with full respect for the Friday PMI landmine. We are not going to chase price here at 1.3455. We wait for confirmation. The trigger is a daily close above the 20-day moving average at 1.3387, which we already have, but with a fresh bullish MACD cross on the daily. Since the daily MACD is currently negative, we need it to flip. That could happen if Tuesday's CBI data comes in strong. So our entry condition is a daily candle close above a 2 at 1.3476, confirming the breakout of the entire resistance cluster. If we get that close, we enter long at 1.3480 on the next daily open. Stop loss is placed below the weekly structural level, at 1.3385, below the 20 MA and the weekly pivot, giving it a solid 95 pip cushion. This is the level that, if broken, invalidates the weekly bullish outlook entirely. Conservative take profit 1 is at 1.3526, the R3 resistance. That's a 46 pip move from entry, offering a 1 minute and 0.48 seconds risk reward if we only take TP1, but we are not doing that. The stretch take profit 2 is at 1.3580, a level not seen since early this year, representing the measured move of the range. That gives a full risk reward of 1 minute and 1.05 seconds. To manage this, once price reaches 1.3510, which is halfway to TP1 in terms of momentum, we move the stop to break even at 1.3480. This locks in a risk-free trade. The explicit invalidation level that would negate the entire weekly outlook is a daily close below 1.3344. If that occurs, the swing trade is dead, and the monthly trend resets. Do not hold through the 3 to 5 days NG entry. 1.3480, daily close above 1.3476, stop loss. 1.3385 take profit 1. 1.3526 take profit 2. 1.3580 risk reward. 1:1.05R, total, invalidation. Void if daily close below 1.3344 risk management pulse. 30 seconds. Never risk more than 1 to 2% per trade. Holding through high-impact event days like Friday's PMI requires even tighter sizing, because the whipsaw can be violent. Stops are non-negotiable, especially on the swing. If 1.3344 goes, you're out. No questions. This is how you survive to trade the next big weekly move. Protect your capital first. The setups will always be there. Here's the close and retention loop. The single most critical level to watch this entire week is 1.3344. That is the line that separates a healthy bullish continuation from a full-scale trend reversal. If UK PMI misses on Friday and US PMI surges, 1.3344 will break, and the monthly trend flips. I will have the updated blueprint for you this Sunday, mapping the new range. But if that level holds and we close the week above 1.3476, the melt up toward 1.37 becomes the base case for next week. Friday's possible finale is the biggest binary event cable has faced in months. Do not trade it blind. Get the levels, get the plan. If you want last week's recap to see how we navigated the range before this breakout setup, that video is live now. Tap the end screen. Then hit the bell so Sunday's next week ahead alert lands before the Asia Open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week. I'll see you on the charts.